Actually, there isn't very much need for the cash in the business. We are profitable, we're cash generating. But Farah, we're 9 years old now. We're not a baby airline anymore. With the established carrier, we have 37% of the Indian market. So I think in any organization, there is a certain milestone that you have to come to where it creates that legitimacy, if you will. It creates that, bigger, as you said, brand and so on and so forth. It's not just brand, but it improves your credit rating when we are going on leasing airplanes, when we are going and getting debt financing. So that helps. So that's one. The other piece is that, Indigo has a unique problem, and in some ways it is a problem, that we are the market leader, we have hardly any competition, we're competing against ourselves every day.
Okay.
And for me and the management team, that rigor that comes in, irrespective of what we try internally today, that rigor that comes in from being a listed company is incomparable.
Okay.
And that creates that much more pressure, that much more of focus in trying to stick with between the straight and narrow and make sure that we come out way ahead in terms of any corporate governance parameters.
But if one were to look at your valuation today, you're almost setting yourself on the likes, or you're benchmarking yourself on the likes of some companies that have been established for over 100 years today. Why the need to so aggressively price your IPO? And what are your estimates as far as your future earnings go that can support such a high valuation?
So actually, I don't think it's a high valuation at all. It's a very reasonable valuation because we are not comparing ourselves to 100-year-old companies. We're only comparing ourselves to the best in the low-cost field. Wizz Air, Ryanair, EasyJet, and these are companies which are 10, 15 years old, some even lower. They're in the same business that we are in. And the valuation is nowhere close to what those companies are at. It's only the multiple. And look at the growth story that Indigo has because of the fact that we are in India. We have found a unique way that not only have we created a 7-year track record of profitability, over the last several years we have kept our cost in US dollars somewhat flattish. And with the NEOs coming in, which are going to attack 10 to 15% of our fuel, we've actually finally found a way that not only is there growth, but actually cost structure comes down, which is not happening in any of these other airlines because the planes are already sold out. We had the forethought and the timing to order these 480 airplanes back in 2011, then order the next 250 airplanes in 2015. So the 180 and 250 put together, we have 430 more airplanes on order. These airplanes are backlogged. Nobody else can get access to these airplanes. And as we replace the current airplanes with the newer airplanes, over a period of 6 years, we actually completely flip out. And we take the lowest cost structure in the world, even lower.
Sure.
So that is really what sets us completely apart, of course, from Indian carriers, but leave them aside, actually sets us apart in a business model vis-a-vis any of these global carriers.
Sure. Now, in this particular IPO, you've got a fresh equity worth about 1,100 crores, and you have an offer for sale, which means it would bring the promoters about 2,000 odd crore rupees. Now, I really am very intrigued by this point. Why the need for a promoter like Mr. Rahul Bhatia
to sell out his? But they didn't want to sell, and but we don't have that much need of the cash, and they didn't want to sell because, and I'm dangerously speaking for them, because they can see this growth in earnings and growth opportunities.
Absolutely.
But what do we do with all this cash in the company if we had done an all primary?
Perhaps retire debt.
Yes, but it is kind of pragmatic also to have a mix of options, mix of financing options. So you just the old adage, right? You don't put all your eggs in one basket. So we've created that slight bit of mix.
But you are going to be taking on more debt as you look at.
No, we don't actually. We are going to do primarily operating leases for a long period of time, and we actually are not expecting to take on any more debt.
So it's going to stay at the current level?
Actually, it should come down a little bit.
Should come down a little bit? Okay. Also, your dividend policy, much talked about, and it's very intriguing.
Yes.
Because one of the questions that has been raised time and again is why did the company feel the need to give its promoters, or rather pay its promoters 1,003 crore rupees in interim dividends in this year itself?
We've actually done interim dividends every year, or for the past several years.
To the tune of 3,500 crore rupees.
Yeah, we've actually paid out 3,500 crores of dividend in the last 4 years. We've been very shareholder focused. Our view on dividends is quite simple. We are profitable, we're cash flow generating.
Okay.
We hardly have any Capex requirements. We look at what's happening in the marketplace, and the surplus cash we've dividended it out.
Okay.
There has been a year in the last 4 years, in fiscal 2012, when we were profitable, we made 140 crores.
Okay.
We generated 900 crores of cash, but we did not pay out a dividend.
Okay.
Because in that year, despite being a private company owned by 2 people, we took a call that no, we should not pay out a dividend because it's not the right thing to do for the business.
Okay.
So we've always taken a very pragmatic approach. We've been shareholder focused and at the same time done whatever is the right for the business. And that view is not going to change going forward.
So this dividend policy stays?
If you call it a policy, because we don't have a written down policy, I just call it this is our world view of how to deal with cash and how to deal with the best interest of the business. That world view of the management team is not going to change. Next is, as far as the negative net worth sort of question is concerned.
I was just coming to that.
Yeah, it's a non-event, and I know it's going to sound a little bit flippant, but it is a non-event.
Okay.
The negative net worth is on that day, as of the 30th of June, as the cash starts building, and the negative net worth is not because of lack of profitability. We made $100 million in that first quarter.
Yeah, but it's been essentially taken out of your reserves and surpluses.
Yes. So the company, the board, looks at what is the projected earnings, and when you feel completely comfortable, and that's when you declare a dividend, an interim dividend, because of which technically on that particular date, the negative net worth happens. But 2 things. First of all, the cash starts generating again, so the negative becomes positive.
Okay.
We've never had a negative net worth year, and this is our most profitable year, so put 2 and 2 together, and that will give the comfort. And the third is that on that particular date, we also have 3,600 crores of cash in the books.
Okay.
So it's very, very healthy cash levels. Our cash levels even on that particular date was 24% of the total revenues.
Okay.
That's Aditya Ghosh there speaking about the company's plans ahead of the proposed